used energy source.
At the Financial Times Energy Strategy Summit, one of the central issues inevitably was the fall in oil prices and what that would mean. The front page of today's paper carried a story about Saudi Arabia, saying Saudi Arabia sees success in fight to retain dominance of global oil. The implication was that investment in higher cost sources of oil, including US shale industry, was being hit very hard. The US shale industry doesn't quite see it like that.
Unlike in the past, when you had a real low price environment that could come in and basically make those changes to drive the price down and really shut off production permanently. I think, first of all, this is a very temporary adjustment and what's happened with production. I think there's a good chance that this can be quite temporary in the fact that cost-cutting measures are going on here in the U.S. that may get most of the players to the point that they can produce at very cheap prices compared to what conventional thinking is today. And in fact, it may backfire on the Saudis in a couple ways.
One issue that US oil producers say would definitely help them is if the country were to relax its restrictions on crude oil exports. They say that would help close the gap between US domestic prices and international prices, which at the moment are about $7 per barrel higher.
Well, now we have oil to export, and certainly it's necessary to do it. But a lot of people have got behind it now. But when we first started talking about it, Financial Times was the first one that did an editorial that brought to the general attention of the public, and wrote an editorial and brought it out that this needed to be done. And since that infancy, we'll call it infancy of media on this subject, now it's grown to a great roar in the country.
Even if US shale oil companies are learning to cope with lower crude prices, though, producers in many other parts of the world are still being hit very hard.
So recently everyone's been talking about what's going on in the US in terms of US investment in US production. And the US is important. It's 13% of world oil supply. But we can't forget to think about the other 87%. And what we're seeing outside the US is much fewer capital projects getting developed, a lot of projects getting shelved, and ultimately that has to have an impact on production. So one of the things that I'm thinking about and I'm watching is really what's going to happen to international production over the next year or two. That might be really where the next cycle is written.
What several participants at today's conference have said is that US shale oil by itself is not going to be enough. Global demand is going to grow and new sources of supply are going to be needed, including deep water and the Arctic.
Well, the piece for me that kind of dominates my thinking is, what does this overall supply demand look like? And so if Saudi is not going to be the swing producer, as it's been for quite a while, then you're going to get these sort of corrections like we're seeing now. And all the resources, of course, have to compete on their own. But the thing that rings true to me always is, this is an industry, when you don't invest in it, it declines at 5 or 6% a year. Think about that. That's basically 25 million barrels a day of production that has to be replaced by the end of this decade, which is $500 billion of investment that has to be made to replace that type of production. We're 1 to 2 million barrels a day oversupplied right now. I think that equation still has to go around. So there's a large element of self-correction here, and I think if they're not playing the swing producer role, then what you're going to see is probably a lot more price volatility around that, but you're going to need higher prices to justify those investments.
And that's a view that was shared by a lot of people here. There's a widespread expectation that oil prices are going to have to rise. How fast they rise depends on how quickly the US shale oil industry can rebound and get back to growth again. Ed Crooks for the Financial Times in New York.